On January 30th, 2026, gold collapsed. Not a normal pullback, not a healthy correction. $530 disappeared from the price of a single ounce within just a few hours, from an all-time high above $5,600 to below $4,900. The real question is not why gold fell. The real question is, how did the world's ultimate safe haven start behaving like a speculative tech stock? To understand what really happened, we need to step back. Since the collapse of the Bretton Woods system in 1971, when the dollar was detached from gold, gold has traded freely on global markets. Yet despite this freedom, gold retained a unique role. Whenever confidence in the dollar weakened, whenever geopolitical risk increased, gold rose. During the 2008 financial crisis, during the 2020 pandemic, but what happened in 2026 was fundamentally different, because the rise itself was not driven by real demand. In 2025, the numbers told a strange story. Central bank purchases fell from 1,045 tons to 863 tons. Jewelry demand dropped by 18%. Industrial demand showed no exceptional surge. And yet, gold surged 66% in a single year. This disconnect between price and physical demand reveals one critical truth. The market was no longer treating gold as a commodity. It was treating gold as a financial instrument. Since the early 2000s, with the introduction of gold ETFs, investors no longer needed physical gold. No vaults, no bars, no storage. They could buy contracts, derivatives, paper claims. By 2025, the volume of paper gold trading was many times larger than the amount of physical gold that actually existed. This is where risk enters the system, because leverage replaces value. Donald Trump's return to the presidency in 2025 reintroduced severe uncertainty into global markets. Trade wars escalated, tariffs expanded, tensions with China intensified. Russia and China accelerated trade in local currencies. Asian central banks began rethinking reserve strategies. A powerful narrative emerged. The dollar may weaken. The global financial system may shift. Gold is protection. $89 billion flowed into gold ETFs in a single year, but this was not long-term strategic investment. It was short-term speculative positioning. Historically, the relationship is clear. When real interest rates are negative, gold rises. In 2025, markets believed the Federal Reserve would face political pressure to loosen monetary policy. That expectation alone drove aggressive gold speculation. Gold was no longer being priced on fundamentals. It was being priced on perceived Federal Reserve weakness. As prices kept rising, speculators flooded into call options. Institutions selling those options were forced to hedge by buying gold futures. That buying pushed prices higher. Higher prices attracted more option buyers. A self-reinforcing loop formed. Gold rose not because of crisis, but because of derivatives mechanics. On January 30, 2026, Kevin Warsh was nominated as chairman of the Federal Reserve. Warsh is known for hawkish monetary policy. The message was immediate and clear. The Federal Reserve would remain disciplined. Interest rates could stay high. The dollar could strengthen. The entire narrative behind gold's surge collapsed in an instant. What followed was not normal selling. It was structural unwinding. As traders dumped options, institutions unwound hedges. Futures were sold aggressively, liquidity vanished, prices cascaded downward. Gold did not lose intrinsic value. The leveraged structure around it collapsed. Long-term holders remained mostly unaffected. Central banks did not panic sell. Retail traders suffered heavy losses. Highly leveraged hedge funds absorbed significant damage. The market did not punish gold. It punished excessive speculation. Does this mean gold has lost relevance? Not entirely. China continues strategic accumulation. Russia relies on gold to hedge against sanctions. BRICS nations still discuss reducing dollar dependence. But January 2026 exposed the difference between strategic hedging and financialized speculation. Gold is no longer just a store of value. It is embedded inside a derivative-driven financial system. Prices now react faster to political announcements than to real economic stress. This is a profound shift. Gold still trades near $5,000. Fear has not disappeared. But January 2026 delivered a clear message in the modern financial system. Even the most stable assets can become violently unstable. The real question is no longer where gold goes next. The question is, has stability itself become a financial illusion? Don't forget to subscribe and leave a comment below. See you in the next video.